Well, good afternoon, everyone, and thank you for joining us. I hope everyone is safe and well, and thank you for spending the time with us today on this webinar where we'll be looking at the American Rescue Plan Act, which was the $1.9 trillion stimulus package signed into law in March of this year, the potential impact that may have on the economy, on people, so employees, employers, and consumers particularly, as well as some broader themes as businesses have navigated the pandemic and continue to do so. Joining me today on the panel, we have Denise Gutchers, Chief Financial and Operations Officer at Film LA, Charles Bonaparte-Wise, Chief Executive Officer at El Gallo Giro Restaurants and Artemex Bakery, and Richard Wu, Tax Principal and Real Estate Practice Leader at GHJ. All industries have been heavily impacted by COVID, and we'll be delving into how that uncertainty has been and continues to be navigated. We've seen a lot of stimulus packages, we've seen changes to regulations, and those have been tricky to keep up with. All of them have had a focus on people, employees, employers, and really driving consumer demand. So with that said, Richard, if you could maybe kick us off by giving us an overview of the American Rescue Plan Act, the provisions and benefits, and in particular, different sectors that are impacted and supported differently by the Act.
Certainly, thank you, David, and hi, everyone. So I will give a brief overview of what was part of the American Rescue Plan Act that just passed, and it lends well to Denise and Charles' segment. So, in terms of what specific items in the Act, you can see on the screen here, and it's nothing, the way this past Act is helping the economy is not very different than the previous CARES Act and the one that was passed last December. It kind of takes on those items and just expanded it, extended it, enhanced it in some way. So there's really nothing like all groundbreaking here. As you can see on the incentive side, there's the employee retention credit, which is the credit given to employers to maintain payroll. And really they didn't really change much of it except extending it all the way to the end of the year. And they also added some specific enhancements to particularly distressed companies, and that's a defined term. Distressed company being 90% reduction in gross receipts. So they added a little bit of enhancement here and there, but overall the program and the benefit did not change. The expansion of credits for paid sick and family leave, again, that's nothing really. They enhanced it a little bit, made it a little bit more higher amount, but it didn't change the program all that much. And the unemployment insurance benefit, it's really twofold. One is to extend the federal supplement of the unemployment benefit of $300 a week on top of the state employment benefit through September. And also retroactively made unemployment benefit received by taxpayer in 2020 not taxable up to $10,200 per individual up to a certain amount of income level. And then there's the child tax credit enhancement. That's kind of a new one of all the things that happened is that they enhanced the child tax credit that taxpayers typically claim on their tax return when it's filed. They enhanced that and made it from $2,000 to $3,000. But the more interesting part is that for 2021, they actually made part of this credit advanceable, meaning you actually taxpayer will get 50% paid starting July 1st of this year on a periodic monthly basis from the U.S. Treasury. And that's to be determined on how the Treasury IRS is going to kind of distribute that fund. Then the remaining 50%, you will claim it on your 2021 return when you file in next April. So that's a new program. And then the dependent care assistance is just, those are employers in the past are able to provide benefits for dependent care to their employees. They made it they pretty much doubled the benefit from $5,000 to a little over $10,000. So those are the significant tax incentives. So again, not a lot of groundbreaking changes, except maybe the advance payment of the child tax credit. And on top of that, you have the stimulus payment, the third round of stimulus payment that just starting, the IRS is still in the process of distributing. And then this category 2 is assistance programs, which is very similar to the previous acts as well. So the previous stimulus plans have always looked at using tax and then grant program or loan programs to stimulate the economy, help the economy recover, and assist certain distressed businesses. And this is no different in this particular act. And I do want to put emphasis on COVID-19 support. A lot of money is being set aside in this act for COVID-19 support, whether that's vaccination efforts, distribution of vaccines, supply chain logistics, and helping public health agencies and healthcare systems administer vaccination distribution and support COVID-19. The Biden administration has made it very clear that the best way to mitigate the negative impacts is to make sure that the economy opens back up as quickly as possible and as safely as possible. So there's a big emphasis on COVID-19 support. BC are Homeowner Assistance Fund and Emergency Rental Assistance. So these are funds that the rental assistance was set up in the previous acts already. So that kind of enhances it, or not enhances it, it gave more funding to it. That's really for the government to help tenants that need help paying rent. Homeowner assistance is government helping distressed homeowners who can't meet, having trouble meeting their mortgage obligations to help pay for their mortgage. And then D is just additional support for the existing SBA programs, such as the PPP loans that we're all very well aware of now, and there's the EIDL grants and stuff. So it's really adding funding to that and making that continuously be available to people who need it. And then E is new. That's a restaurant revitalization fund. And again, this is with the purpose of helping an industry that is obviously very severely impacted by this COVID-19 pandemic. And Charles can certainly attest to that later on. But this fund is set up and it's going to be administered through the SBA as well. It's a fund for distressed restaurants to apply for grants, assistance from the SBA. It will be a grant, so it is not a loan. And then they made it clear as well that for tax purposes, unlike the PPP loan where there was all that issue about whether it's deductible or not, they made it clear that it is a grant, not taxable, but you can also deduct whatever expenses you pay with the grant. So you get a double benefit here. And it's a formula-driven application process. So essentially the amount of grant you can get is you take the difference between your gross receipt pre-COVID, I should say 2019 versus 2020. And that difference is actually what the grant will be based off. There is some restrictions to who can apply, such as public corporations cannot apply. Also, there's a number of location restriction as well. So there's a variety of different program details that the SBA is still trying to come out with regulations and how to apply, who can apply. So the portal is not yet open as of today, from what I know. And F is kind of went to the kind of supports the spirit of the act, is helping state businesses or states help their small businesses with liquidity. And this is really it's called the State Small Business Credit Initiative. It's lending support to small businesses that need money, loan, collateral, just funding to help them stay afloat. And this isn't a fund that's set aside. Each state has their own kind of ways of doing it. But it's really up to the state to administer this fund. But all the items under the system programs here, as you can see, led to the overall theme is to prop up the economy, recover the economy, help distressed industries that is really severely impacted, and then also helping just individuals with meeting their living expense needs, such as mortgage, rent, unemployment, and stuff like that. So it's 1 and 2 is, again, continues the theme of the previous 2 stimulus plans. So that's what I have here for the summary. So David, I'll turn it back to you for the other speakers.
Yeah, thank you, Richard. And there's a lot in there. So it's a very helpful summary. And I'm sure that there's certain things in there that catch people's eyes and certainly catch different people's eyes differently. And with that said, Charles, maybe if we could turn to you and if you could talk about the Act and how that impacts your business, and in particular the Restaurant Revitalization Fund, which is a very generous, I think as you referred to it, almost too good to be true package. We'll see kind of how that all works once it opens up. But maybe you could talk about the Act generally and what that means for you in terms of reopening locations and so forth.
Yes, hello. So we, before the pandemic, our restaurants sold about 50% takeout, and we were lucky to be able to transform this into about 90%. So we've been affected throughout the pandemic about 15%. That's important as a background because some restaurants, unfortunately, were not able to do this and were hit a lot more than we were. In one of the quarters, we were down more than 25%, which allowed us to get funding from the PPP-1, but also from the PPP-2. Although we did not get the full amount that we were entitled to in PPP-2 because there are some glitches at the SBA system level where the higher amount available for restaurants, which was 3.5 times average payroll, really was limited to the 2 million cap. So we got a smaller amount that we should have been entitled to. The nice thing about the new Restaurant Revitalization Fund is that it'll make up that difference. And I think that's really important for the businesses that were not 25% down in any of the quarters. Because in the restaurant industry, it's terrible if you're 10% negative to the previous year, you're in trouble. 15%, it's really bad. 20%, you're going almost bankrupt. Let me say this, although I love our restaurant company, and we were fortunate to do okay during the pandemic, we would have been bankrupt if it wasn't for PPP help. So the PPP funding was critical for us. The Revitalization Fund will help us even further. It's a really nice thing, but I think it'll help other businesses that were not able to get PPP-2 funding. And it will I think it's something that allows more companies, every restaurant company basically, to make it through the crisis.
Thank you, Charles. And I think that you picked up on a fairly common theme there as well, which is certainly with PPP and perhaps some of the other packages as well, is that the funding is critical, absolutely. Also going hand in hand with that is maybe some glitches and or complexities in terms of actually receiving the funding and confirming the right amount and so forth. And especially in an environment where the regulation around that has been changing and continues to change almost daily, certainly at the outset.
And that's been very difficult for us. The uncertainty and the constant changes, it has increased a lot of costs just by not knowing if we were going to get a second PP package. And so we had to, cut maybe more expenses and do things that we wouldn't have to do and undo and redo, which generated additional costs.
And Denise, turning to you, as far as the entertainment business, and as you look at the Act, what do you see the Act doing for your employees, customers, in terms of bringing the economy back to pre-pandemic levels? And obviously the entertainment industry is a very broad and deep, particularly in Southern California area that I think we're all interested in. So I'd love to get your perspective on the Act and what that means going forward for you.
Well, thinking about entertainment in the city or county of Los Angeles, right? As you said, huge impact on the economy. And that's part of what we do at Film LA. We're a 501c4 and we're about economic development, supporting filming here regionally. Just much like, I'll give you a little brief background like Charles did, we saw a complete halt in production in March, right, of 2020. And it took several months, even after the LA County Department of Public Health issued some guidance on what production could do. But, we had major studios, we have the unions and the guilds having to negotiate to protect their members. So By August, we actually saw, more activity coming forward, roughly about 30%. Today, we're seeing, and this is on location. From our perspective, we coordinate on location filming and television, not in the sound stages. But we see right now we're roughly about 50% of what our historical activity used to be. So when I think about the act and what that means, it means, providing more support for employees who might have been, who have had reduced wages, who've been unemployed. The unemployment benefits of not being taxable helps people to really kind of come back to the workplace and reinvest in the economy, consumer spending, right? I think that's the idea of the act in some ways. But for our employees, we laid off 50% of our employees early April of 2020, slowly started bringing some back. We furloughed, not laid off, but then we did recently lay off about 10% of our employees just because we're a small organization. What I'm encouraged by are the tax credits with childcare assistance, the emergency rental. We as a small employer have lost a number of employees due to the fact that they couldn't survive on the reduced hours or on unemployment. They've moved out of state. And while we've tried to accommodate that, there's a cost associated with accommodating multi-state employees that you have to think about. But there's a lot of great things that can happen with, particularly for the small businesses. When you think of, when most people think of entertainment, they think of the major studios, the big productions. There's so much out there that are independent, small filmmakers that really can use the support, particularly with the LA County Department of Public Health, what we call the Appendix J requirements for the film and entertainment industry. Huge additional costs to be able to go out on location and have social distancing, testing daily, to be able to have some support for that, for particularly the small filmmakers, as well as the ancillary businesses that support the industry, craft services, prop rental houses, et cetera. As we look at this and we think this will help bring back the economy and Los Angeles in particular, because we are still the film capital of the world, despite what Georgia and New York want to claim. Those are some of kind of my initial reactions to it. As I explained to Richard and David and Charles when we first met to talk about this, is like, I'll never claim to be an expert on the act. I will rely on experts like Richard, but I'll focus on the things that make sense for our industry. And the last thing I will add is the employee retention credit. Significant, particularly for organizations like ours. We are a 501c4 and we don't qualify for PPP. So that retention credit made a huge difference for employers like ourselves.
Thank you, Denise, and glad to hear that you were able to access the retention credit, and kind of the support that, as Charles referred to, is really critical for these types of businesses. So thank you for that. A question for the group as a whole, and so feel free to chime in as and when. Do you see that the Act has a meaningful impact on opening locations kind of in the short term? So whether it's filming locations, Denise, or whether it's restaurants, Charles, or shopping centers, movie theaters, performing arts centers, all the different types of locations that have been really forced to close over the past 12, 13 months. Do you see the Act as really moving those closer towards reopening, or is it something that takes time to trickle through and doesn't really have that short-term impact?
I will respond to that. I think how you define short-term, right? Since the pandemic, 1 year feels very, very long-term. But I think that it's going to be more of a midterm impact. Particularly, as we go into orange tier in the state and whatnot, businesses reopening. And we know that the, kind of the complications with things like the SBA loan administration and how they award loans, et cetera. I think it's a little bit more of a midterm, but the fact that we are reopening businesses even at 25% capacity is huge. So I think the Act, as well as the fact that we're seeing vaccinations. It's all coming together. I'd like to say I believe it's going to have an impact, within the next few months. I'm cautiously optimistic by end of year we'll see a much, stronger impact on the economy.
I would say that for the restaurant industry, the difficulty has been that our costs have increased a lot during this time. So all the tax credits that you refer to are nice. There are short-term help for this year, which is great to get back on track. But the level of expenses have increased a lot. Labor costs, very difficult to get people interested in working, because this is a hard industry to work in. People are just slow to getting back to work in general. So yes, I think this act will help re-energize the economy and speed up things so that we can get back to business to normal. But the key out of this program, I think, is to be able to get back to profitable restaurants. And I know a lot of restaurant owners who are skeptical about reopening business, because if they are not going to be at 100%, they're going to lose money. So why get back in business? And if they have several locations, they might not open all the locations. They might just open the best locations. And they will do it with minimum menus, minimal expenses. They will try to hire the least amount of employees back, just because costs are very, very high in the restaurant industry, and food costs and labor costs are high. So those are the two main components. The restaurant industry is very operations intensive. So that's something that, we've struggled to explain to our landlords, for example, during this pandemic. Say, oh, you're in this restaurant, you're only 20% down, you're lucky. Other restaurants are, 80% down. Well, I know a lot of people who were 30% down and they didn't reopen because it wasn't worth it. They were just losing more money. So they're kind of sitting and waiting. So I think that these tax incentives, employee credits, etc., will help offset these increases in costs. And I think overall, well, hopefully, the restaurants will reopen. We've been fortunate to maintain all our locations open during this pandemic. But I got to tell you, these 3 first months have been losses. Although we're close to the pre-COVID levels, and we're just less efficient with reduced menus, reduced hours. We should be more efficient, but it's very hard to get people trained and get the restaurant just working 100%.
Yeah, and I think to kind of summarizing what Denise and Charles both said, I think if you look at this act in particular, well, actually all 3 acts, if you look at it, it's, I think of it as a drain, and the water's going out, and these acts are trying to just patch it up and band-aid it so that it doesn't drain out as fast. But at some point, these short-term band-aids can only do so much. What really needs to happen is the restrictions in COVID-19 to continue to drop the way they're dropping, and the economy needs to be opened up, the restrictions limited. Like Charles said, restaurants, if they can only open at 25, 30, 40% occupancy capacity indoor, they're not going to make money, so why even bother opening? So the only way to really get back into it is I think it's that, if you look at my previous slide, the COVID-19 support. And I don't know, if you look at the details of this COVID-19 support in this act versus the other 2 acts last year, it is very much, first, the funding is very high. There's a lot of money there. And there's very, very targeted at distribution and the system as a whole to try to get everybody back. And I think you can see that with this act, with the Biden administration's priority. They know all these things are just short-term band-aids. You can't keep pumping out $2 trillion every quarter and every few months. I mean, it's just not sustainable. So the only way to do that is to get the coming back open. So I think with the act, it's great because of the short-term band-aid. It helps, like Charles said, these credits and incentives help offset costs, but it certainly doesn't help them become profitable. It just makes them hopefully break even, best case, but then have mitigated losses. So I think the act, David, to your question, is it goes to that, it serves that purpose, but going forward, it needs to be a lot more than just band-aiding it.
Yep. Well said, Richard. Thank you. And with that, actually, I may turn back to you, Richard. And you know, one of the topics that we talked about in the run-up to this webinar was real estate, which, like food and beverage, like entertainment, has been very heavily impacted by the pandemic. So my question to you, Richard, is what does the Act do for real estate specifically? And then perhaps more importantly is, with that in mind, what's your outlook for real estate over the next 12, 24 months?
Yeah, when you look at real estate, I always think about the three major classes. You have residential, you have commercial, and then you have retail, and then you have a couple of fourth category with, you know, industrial, mixed use, etc. So you kind of have to look at that real estate as in those three buckets. So residential, you know, with the emergency rental assistance and the homeowner assistance fund, it definitely helps, right? It keeps people in their homes. It keeps people be able to meet their mortgage obligations, and the mortgage forbearance continues to be a big driver there too. If you look at the residential market, the multifamily market, obviously it's very location specific and dependent when it comes to real estate. What state you're in, what city you're in within the state. But as a general whole, and we had a webinar last year actually on this as well, is the multifamily and residential market is actually not bad at all. I mean, if you look at the vacancy and occupancy rate, I think it was still above 90% even back last year. So all of the act, what the act, this particular act does, continues to help the residential. The commercial is a little interesting, and I think we also talked about this. And I think back last year, and I kind of want to go back last year, you think about people were screaming that the death of the office space is here, that companies are closing their offices, everybody's moving remote, moving to the suburbs, moving to the, you know, lower cost cities or places to live where they can buy a home instead of commuting into the city. So the office space was going to die and it was going to be gone. And then now what you actually see, and I think back then we talked about too, let's not get ahead of ourselves and overblow the situation. While some of that reversal is permanent, but now if you look at the latest, at least towards the end of last year and early this year, you're looking at people talking about Zoom fatigue, mental fatigue from working at home all the time, because the lines between work and home life is blurred. Well, last year it was great because we have kids not being able to go to school, so parents have to stay home, et cetera, to take care of the kids. It was great to have that flexibility. But now that schools are reopening and kids are kind of starting to go back to school and in-person learning anyway, you have people that talk about, you know, I'm so tired of working at home all the time. I want to go to the office. I want to have that separation of work and life, right? So, and we have that in our own firm, David, you know, we talked about this internally as well, that, you know, it's great that we have a place to go to. So people actually want to go to the office to kind of separate that. So once you see, so some of that last year's reversal is not all permanent. Some of it's starting to come back. What you will see in a commercial space, it takes some time to kind of see on how that translates into the real estate office space. But you'll see companies, maybe they'll shift, downsize in their footprint, but they're certainly not going to just get rid of their offices and go completely remote. While companies have invested a lot of in infrastructure into remote working, but they're going to have space. They might reconfigure the square footage. Maybe they'll make it more community friendly, more remote, kind of hoteling friendly than in the past, but you'll have that office space there. So I'm personally, the commercial space, I think maybe you have a short-term blip, but I think long-term companies will kind of continue to stay with the space, make it more of a creative space, and then people will want to go back anyway. Retail, and just before I sum up, retail is, if you really look at retail, before COVID-19, retail was already on getting hit. You have Amazon, you have remote online shopping, so you have places like Macy's, Sears. I mean, they were already getting, you know, the writing was on the wall, so to speak, right? Because they were already getting hit with all the remote working. And the COVID-19 just kind of really accelerated that a little bit for the retail space. So I would say retail is definitely a more challenging space to be in. Hospitality always comes up too, but, you know, when tourism comes back, travel restrictions lift, the hospitality will come back as well. But the retail is definitely harder. It's difficult for the retail, but that's even before pandemic. So basically, sum up, I think the real estate market, what the act does for the real estate market, it's all good. There's nothing bad. And I think it's still, they have a positive trend, I think, in my opinion. And interest rate continues to stay low. I mean, the Fed chair, Jerome Powell, has said that rates are not going to move, at least in his mind, not going to move anytime soon. So you think, unless something, I mean, they can always something can change, but interest rate being low, and real estate always gets really impacted with interest rate. It's a good situation, I think, for real estate as a whole.
That's really insightful, Richard. And I know that I can certainly put my hand up and say that I have lived that 360-degree turnaround from office to working from home to, really looking forward to getting back into the office and connecting with individuals face to face. So we've talked about what's in the Act, and I will ask maybe Denise if you could chime in terms of what's not in the Act that you would like to have seen as a business leader. And certainly one portion that jumps to mind that was negotiated out of the Act, which is the minimum wage provision that was included in some of the drafts, but ultimately was not in the final Act as it was signed into law. But from your perspective, Denise, what do you not see that you would have liked to have seen in the Act or in any of the stimulus programs?
Well, from a very selfish standpoint, I mentioned this earlier, right? Is a 501c4, nonprofits were carved out in the Act, based on specific, a nonprofit status. And, for 501c4s, we vary quite a bit across, the work that we do. They're generally deemed as lobbying organizations. We're not a lobbying organization. We're an economic development corporation that does absolutely no lobbying. So, what I would have liked to have seen, and there was some lobbyist activities, by the way, in DC to try to get C4s in the Act, but would have liked to have seen a little more or a little less restriction on that, so that organizations like ours who are about economic stimulus could survive longer term. And I do agree with you also, David, on the minimum wage piece, which I understand, there's a lot of pushback on that specifically, but, particularly when you're talking about, the higher cost metropolitan cities and what that means for, people being able to stay and live in these areas, more and more migration away and stimulating other cities. But, those are the two things that pop off the page for me immediately. I have certainly, focused on those, but that's really my initial reaction to your question.
Charles, do you want to add anything on to that as well?
Yes, I'd like to say, I see the Act as quite complicated for operators. And I know a lot of smaller operators who have had a difficulty or simply haven't applied for all the packages available, for all the benefits available. We still haven't applied for all the tax and all the help that is available. So by making it very complete, they made it also very complicated because you have to apply to so many things. And then if you have more than one unit or more than one company or LLC, then you have to duplicate or multiply all this work. So it's very time-consuming and complicated for people that are trying to adapt their business to changing dynamics. I've spent at least 50% of my time on administrative matters, and we've been successful in getting the PPPs, and we also got some EIDL loans, although that was a mixed result. Some of our restaurants got the EIDL, and with the exact same application, we did not get it. We had to reapply 2, 3, 4 times. Sometimes we're still in a limbo waiting for the SBA or for some systems to give us an answer. So I would really recommend small operators or any operators, in fact, to apply to really look into this and to make sure that they get the benefits from everything that's available. And that's complicated. It's difficult. It's not very clear. Right now, for example, for the Restaurant Revitalization Fund, we don't have guidelines. They're probably going to come up in April, and we don't know exactly how that will work. So it's kind of hard to prepare, but there's things we can do to prepare.
Yeah, thank you, Charles. And again, that's a theme that we've seen across multiple industries and businesses, which is that the complexity of the funding and at the federal level, it just targets so many people that there are always going to be different folks who fall into different sort of grey areas and so forth. So certainly don't envy the folks who write the act and try and structure it in a way that is streamlined for every single operator and business out there. But I do agree with you, Charles, that is a common theme that we've seen across different recipients of the funding.
I would also like to add that for the future, I mean, the key here, again, this is a short-term fix. It'll help during this year.
Yeah.
But the key is for businesses to really relook at their business plan, make sure that the business is going to be sustainable in the future. Otherwise, why go through all this? So at the same time, we have to adapt to new dynamics, hiring difficulties, operational training, etc. Reshape our business and deal with all these administrative matters and apply for all these different things. But I think it's really important to keep our eye focused on the outcome, where we want to be as a company in the future, and how will we survive, and how our P&L will look like, and our balance sheet, because that's another disruption. As we've been able to negotiate some extensions and some payment deferment in rents and utilities, etc. All this, if the bank still looks good with these helps, we're now not more in debt than before. So that changes, the risk factor for businesses too.
I couldn't agree more with you, Charles. I think that the concept of kind of reopening, recovering, and then rebuilding so we can thrive and sustain means we have to think differently in many ways about how we do our businesses, and be very cautious about, the spend, which we have been. But, in our business, we were fortunate enough to have the fiscal foresight to put, millions of dollars away over a 10-year period, so that we could survive some form of a crisis. We never predicted it was a pandemic, although it was one of our scenarios in our business continuity plan. But not every business has the luxury of doing so. But I need another 10 years to rebuild that at historical activity levels.
Well, congratulations, Denise, for doing such great planning. Because I think probably most businesses are not able to do that.
No, it's not an easy, it's a discipline that requires, constant vigilance in terms of spend and being strategic about your business. But yeah, we were fortunate enough to be in that position. I don't foresee that being the case going forward. We have to be even more vigilant. And as I said, as you had said, we have to think differently about how we operate. And be creative and innovative in that way. Take advantage of the act if you can, but as you said, Charles, be mindful of the balance sheet effect.
Very good.
I actually really like that sort of voiceover that you gave, Denise, and again, just to reiterate Charles' opinion, which is, very forward thinking and a lot of foresight from yourself and your organization as far as predicting something, not COVID necessarily, but some development that would require, dipping into kind of reserves and so forth. So I'd like to expand on that actually a little bit, because what we certainly have seen is that any organization, whether it's entertainment, food and beverage, real estate, the ability for the organization to pivot, do things differently, requires a certain level of management buy-in, the right team, and the right culture in order to do that during the midst of a pandemic or whatever the crisis might be, if it's a recession and so forth. So my question here is, how has this pandemic, how has COVID-19 and the economic impact, how has that changed your operations and your business model going forward, even after COVID has subsided? So there'll be masks and there'll be social distancing and so forth, probably for a number of years, I would imagine. But there's also, supply chain, customer base, food safety, Charles, specifically for you and your business. Maybe ask the group, how do you update and change and learn from the past 12, 13 months, and what does that mean going forward?
Well, for us, first of all, I'm very grateful that we've been able to keep our team together. From the first round of PPP, we've committed to keep the same payroll levels as before. And I forgot to mention, but we also have a central bakery and commissary for our restaurants. And out of this food plant, we sell frozen bakery goods to other supermarkets and school districts, for example. So that business went up actually, and we were able to, maintain some hours of employees in operations that went down, and give them hours of work in operations that went up. So we were able to maintain. We were lucky enough to able to maintain the same payroll levels as pre-COVID. However, our management has pretty much 90% of our management is still in place now, the top management, and they've been fantastic in helping us, manage the crisis. So all our operations have survived thanks to our team. That's really important. That's really important because it would be an additional burden to have to retrain everybody from the bottom up. I don't know if I answered your question.
I think, what's changed for us is there was a period of time before COVID where we just kept expanding services, responding to customers and clients' needs. It forced us to step back and say, now's the time to look at the opportunities to change the way we do business so we can be more efficient, we can be more customer friendly, or leverage technology in a way that we never did before, again, to keep our costs down. It meant we had to invest more in technology during this period, which seems counterintuitive when you're losing money every day. But that was a long-term vision of saying technology is our future. How do we use it to make us more efficient again? And we're constantly doing that. I mean, I pull my senior leaders, our team together, and we have that, right the wrong kind of a conversation. What are we doing that is a legacy practice that we can improve based on what we've learned during COVID? And constantly using that muscle of thinking differently about how we do business to better the business and make it sustainable. So we have changed a lot of our practices over the last 12 months that we wouldn't have predicted 2 years ago.
I couldn't agree more with you, Denise. We have invested more this year into 2020 and then in the last 5 years, in technology and newer equipment, just to streamline my operations, be more efficient, and be able to compete better.
Yeah, and then I know we're want to leave some time for Q&A, but I would just add on the real estate side, what COVID has done is that, the successful real estate investors have always done this, and they've always looked at a very long-term approach to their business, to their investing. And sometimes, and just like in any other industries, real estate, people that are in real estate and investing in real estate, just like they sometimes fall trap to what's hot and what's trending. What are the cities that's up and coming? But by the time they get there, it's already a little, they're behind the game already. So when I talk to a very successful kind of a real estate fund, is they're actually going very long term, and they've always done it, but the COVID has shown that that their way of doing it was right, and they go beyond just what's kind of trending. They look at infrastructure spending from the government. They analyze the environment. So I'll give you an example. They looked at which way the water was flowing from the mountain to east or west. So if it was flowing, west, the government will have to spend a ton of money to direct the water the other direction. So there's no way that side will get that much government infrastructure investment and to have that city kind of develop. So that's just an example of what they've done. I think you'll see more of that where they're looking at a much more long-term play than just kind of, oh, this is the hot and coming trendy state. Let's go there. So I think there's a lot more of that planning and thinking way ahead, way down the line for that. So.
Thank you, Richard. And again, almost as if you're preempting where I may pitch my next question. And you talked about sort of infrastructure and the broader economic picture. And this is a question for the whole panel, and then we should have some time for questions that we've received from the audience before we wrap up. I think it'd be interesting just to talk about and explore what the Act means down the road from a broader macroeconomic point of view. Tax is obviously the big one in terms of administration, and ultimately the funding has to be recovered and paid for in some way, shape or form. Then there's the impact on inflation, interest rates, unemployment and so forth. And particularly from the perspective of mid-sized privately held businesses, I'd love to hear from the group, and maybe Richard, you could lead us off in terms of what the Act means down the road from a macroeconomic perspective.
Yeah, I think it's a perfect segue into it. And I think what you see, in my opinion, is, and we talked about internally, is that this last act, or this act, is probably the last broad stimulus package the way you've seen it. And the job report that came out last week, that was released yesterday, shows that the job report actually came out with pretty good numbers as a whole, right? So what you see from a legislative perspective, and as the administration and Congress looks at what their priorities are, the economy, the indicators are showing the economy is on the way, right? They've done its job. So what I think you'll see is that the stimulus, there probably won't be this kind of level of stimulus like this. It's probably the last one. Second is, it goes back to your point, David, is financing. So just for your information, all the past acts that's been passed primarily has been financed with debt. And now that deficit spending can only last for so long. At some point, you got to figure out how to raise revenue too. So pivoting to the Biden administration's next agenda item is infrastructure spending, which he's always been making a very big emphasis on, the roads, the bridges, all that stuff. But you got to pay for it, so you got to raise taxes to pay for it. So I think tax will be a main hot topic as he looks at raising corporate rates, raising individual rates on high income earners, wealthy individuals, and then looking at also industry specific. So for me, I mean real estate, there is a couple of real estate items that was on his agenda and that would have a astronomical impact on the real estate if he was to go through with it. And so he has industry set, targeted industries, and then just general tax revenue. He's looking at increase in tax rates. So you'll see that as a next item, but how quickly that can get done is really a struggle, because I think you'll see that there's a lot of politics involved, obviously. So I don't think it's going to be super fast, but it's going to be the item of focus for the next 12, 18 months.
Now, for now, we still have the benefit of what's the name of it? The accelerated depreciation, right? So any capital investment that we do this year is still able to be deducted, and you can carry it forward or carry it backwards even. So that's a big tax incentive, I think, that could be used by companies that receive more help or more financing. And I want to add that we invested a lot, but we got more debt outside of the government debt in order to have more of this cash cushion to go forward. So we've been able to do both, invest more and increase our reserves, which I think is important because, yes, this is probably the last big stimulus, and then payback time will come sometime soon.
Payback, you're exactly right, Charles.
I don't have much to add because that's exactly where it comes down to. There's some payback down the road. We all have to anticipate it. And like Charles is saying, leverage what you have available to you now. And think about the fact that we are going to pay more taxes. We're going to pay it back. Inflation is going to happen.
And on that subject,
I have one more thing to say. Invest in real estate because it's cheaper now.
And I'll pick up on the point you mentioned, Denise, about inflation, and particularly thinking about wage inflation. And I mentioned earlier about the minimum wage that was negotiated out of the American Rescue Plan Act. One of the questions that we had from the audience, and we have 8 minutes, so if folks have other questions, please continue to submit them through the Q&A. But one of the questions we did have, Charles, is for you on minimum wage. And the question is, how has minimum wage impacted the food and beverage and the restaurant industry specifically in terms of the lack of the minimum wage in the Rescue Plan Act, but then also historically gradual increases in minimum wages that we've seen in California? So we'd love to hear from you in terms of how those increases have impacted from a restaurant perspective.
Yes, those were very hard to manage for restaurants because they came at the worst possible moment. They were never discussed or part of any rescue plan. So especially, I mean, and I forgot to mention, we're in Southern California, so our minimum wage is around $14. It's very, very, and it differs from city to city, but it was very difficult. But this is compounded by the difficulty of getting people to work, getting people in the restaurant industry to work. So there's a compounding effect that's made it very difficult from a labor standpoint. And that's why we've looked at different technologies to try to streamline as many things as we do in the restaurants. And we try to give the best service as possible and keep things as clean, as sanitized and safe for the customer. So there's a compounding effect that's been pretty difficult to manage. But again, if you look in the future and stay focused on the goals of coming out stronger out of this crisis, you know, everything you should do should be focused on that, coming out stronger. You cannot come where you were before because you'll lose money.
I think coming out stronger is a beautiful message, and I think it's one that a lot of business leaders that we interact with certainly repeat many times as well. So thank you for highlighting that, Charles. Another question that's come in from the audience is probably a hybrid between Denise and Richard. I say Denise because you mentioned about investing in real estate, and Richard, with your expertise in that industry, the question is LA and San Francisco, are those good areas when you look at real estate? What's your outlook for, I would say, already very heavily metropolitan areas like Los Angeles and San Francisco versus those that are more up and coming, maybe like an Austin or a Denver or Las Vegas from a real estate perspective? Do you see those as fundamentally different markets as far as your outlook, or is there some commonality in how you look at them?
Yeah, so I can answer that in a broader picture. So California, you know, in terms of real estate, kind of the market here, and California is obviously still a very attractive place to be. You know, the Southern California weather, it's people like living here. one thing that we have seen, and it has actually been driven not really by the real estate fundamentals per se, but by the tax rates in California. So we have seen, at least from kind of some investors doing this, their investors don't want to have that much exposure in California because of the high tax rate here. So they'd rather invest in other areas because, you know, once you invest into, if you're a California non-resident, you're investing into California, you're now under the California tax jurisdiction, right? And some investors don't want that because of the high rate plus there's been proposed to increase that rate even further, right? So, you know, I'm sure just like any state, there are always pockets of places that you can invest, but California as a whole, I think that's why you see a lot of people investing outside of California is because of that shift in moving out to a lower tax jurisdiction. And then I saw a question, and I don't know, Dave, I can just answer that from the audience, that commercial real estate will bounce back. Sometimes, whether there's a hybrid form with occasional meeting space access will supplement remote work, isn't this trend more widespread for many businesses? And the answer, I completely agree with that assessment, is that commercial real estate may not bounce back immediately to the pre-pandemic levels, but I think what the theme is that I don't think the death of commercial real estate should be overplayed as much either. So it's not so positive, but it shouldn't be that negative as well. While it's true that, you know, people, especially in LA with the traffic, is just, once everything opened up, the traffic is going to get worse and worse again. And I think you'll see that in LA, but some of the other states, I think you'll see continue to have, that's why I think offices are going to be more creative in what they do with their space, existing space. And if they're signing new space, they'll look at it differently. So I don't think it'll bounce back immediately to what it was before, but I don't think it's going to be, you know, the death of the office space.
Yeah. And I think we're at 12:58, so it's probably a good time to start to wrap up. I do want to thank the panelists, Denise, Charles, and Richard, for joining us and giving us your insight, as well as, of course, you, the audience, and the team that we have behind the scenes that sets up these webinars as well. So I appreciate you spending the time with us. The slides from earlier in the session will be available, as well as a recording of the webinar as well. So if there are any questions, feel free to reach out. The contact information is on there. But a big thank you to the panelists for joining us, and to you, the audience, for spending the time with us as well. Thank you all.
Thank you for having us.
Thank you.
Thank you,
Thank you
everyone.
very much.